In 33 AD, the Roman Empire faced something it didn't even have a word for: a credit crisis. Money disappeared, merchants vanished, and senators sold estates for scraps of silver. It began with a single decree: all debts must be repaid in coin, not promise. Within months, Rome, the richest city on earth, had no liquidity left. Trade froze. Sound familiar? 2,000 years later, the same pulse echoes through Wall Street screens. A sudden tightening, a silent panic, a chain reaction no one admits to starting. Every empire, ancient or modern, runs on the same invisible engine: trust. And every collapse begins when that engine stalls. History records 7 repeating phases, not in myth, but in data: expansion, speculation, saturation, inflation, implosion, control, reset. From Rome to the Dutch tulip markets, from the South Sea bubble to 1929 to 2008, the pattern is almost mathematical. Each phase lasts decades. Each begins in optimism and ends in denial. In Rome, debt was a duty. In the Renaissance, it became opportunity. In the 20th century, it turned into oxygen, the air modern economies breathe. But oxygen burns. When too much accumulates, one spark is enough. The irony is brutal. Every civilization builds its wealth by promising the future. Then, one day, it demands that the future pay in cash. That day is always called a correction. In truth, it's an autopsy. Some historians believe the fall of Rome began not with invasion, but with accounting. A silent implosion of confidence hidden behind imperial grandeur. The same can be said of our own age. The digital screens may glow brighter, but the mechanism beneath them hasn't changed in 2 millennia. If debt is history's heartbeat, then we're already hearing the arrhythmia. If this opened another side of history for you, comment where you're watching from. The story of economic collapse never begins with chaos. It begins with confidence. Rome, at its height, was not a civilization in decline. It was the most efficient financial machine the ancient world had ever seen. Its roads, armies, and taxes formed a single system of circulation. Gold and silver moved through it like blood through arteries. And just like blood, the flow had to continue, or everything would die. The first century before our era was a golden age of credit. Wealthy senators financed trade across the Mediterranean, lent to provinces, and invested in estates they would never visit. Money multiplied through promises, legal contracts written in wax tablets, backed not by coin, but by reputation. A senator's word was worth more than a purse of denarii. Trust was Rome's true currency. But trust is fragile. By 33 AD, Emperor Tiberius faced a strange dilemma. Prices were rising, yet money seemed scarce. Loans had expanded far beyond the empire's actual supply of metal. When a few large debtors failed, panic spread like fire through the forum. Lenders demanded repayment in hard coin. Suddenly, every promise turned into a liability. That moment, a contraction of trust, was Rome's first modern-style credit crunch. Tiberius, cautious by nature, tried to stabilize the situation. He ordered the state treasury to issue emergency loans, interest-free for 3 years, secured by land. It worked, temporarily. Markets thawed, property values recovered. But the underlying disease remained: the system's dependence on continuous debt expansion. Sound familiar? What we call finance today was born in that contradiction. When the Roman Empire shifted from republic to autocracy, its money shifted too, from private to political. The emperor became the guarantor of stability. The illusion of control replaced the balance of risk. Every future crisis would repeat this pattern: more authority, less trust. Move forward 15 centuries. In Florence, in Venice, in Amsterdam, the same mechanisms reappeared under new names. Thanking families issued letters of credit, monarchs borrowed for wars, merchants insured their cargo. Capital was still trust, disguised as paperwork. And every empire, sooner or later, reached its own phase 5, the moment when promise outruns reality. Economists often imagine progress as a straight line, from primitive barter to digital money, but history suggests it's circular. Every financial civilization climbs the same spiral staircase: innovation, expansion, speculation, collapse, regulation, and restart. The steps repeat even when the scenery changes. That's why the Roman episode matters. It wasn't just an ancient accident, it was the prototype. The credit network, the liquidity crisis, the state intervention, all the instruments of modern finance already existed, only in slower motion. Rome was the first laboratory of leverage. Its collapse was the first warning. Some historians describe the Roman economy as primitive. In reality, it was sophisticated. And precisely because it was sophisticated, it was vulnerable. The more complex a system becomes, the more invisible its points of failure are. The same law governs today's global markets. The faster the flow, the thinner the margin for error. In every era, confidence is mistaken for stability. But they're opposites. Stability resists time. Confidence depends on it. When belief fades, no decree or central authority can restore it by force. Rome learned that truth the hard way. Every empire believes it has found the formula to avoid collapse. Rome had gold, Britain had colonies, America had credit. Each thought it could turn expansion into eternity. Each discovered that growth, like gravity, has limits. And now imagine, if the pattern is that precise, if the stages repeat with mathematical rhythm, then maybe we're not watching history unfold. Maybe we're reliving it. If this gave you a clearer lens on history, tell me where you're watching from. Every system breaks not at its weakest point, but at its most trusted one. For Rome, that point was money. It wasn't supposed to fail. It was backed by gold and silver, stamped with the emperor's face, blessed by divine authority. Yet in the first century, something subtle began to corrode it from within: the imbalance between promise and substance. The crisis of 33 AD revealed the structure's first fracture. But the deeper problem started earlier, with the empire's hunger for growth. Expansion required armies. Armies required payment. Mines in Spain and Gaul could no longer keep up with the appetite of conquest. Rome did what every empire does when its reserves run thin. It debased the currency. A denarius that once contained nearly pure silver was gradually diluted. By the time of Nero, less than 90% remained. By the 3rd century, only 5%. On paper, the numbers were the same. In reality, the money had evaporated, and yet the illusion held, for a time. Trade continued, taxes flowed, monuments rose. Inflation was treated as prosperity. The empire seemed unbreakable. But the mechanism had reversed. Instead of wealth generating confidence, it was confidence generating the illusion of wealth. Now pause for a moment. What happens when an empire believes its coin can buy eternity? When the symbol becomes more valuable than the substance? That's not just a financial problem, it's a philosophical one. The collapse didn't come as an explosion, but as erosion. Prices soared, salaries lagged. Soldiers demanded more coin for the same service. The state minted faster, the metal content fell lower, and trust slipped quietly out of circulation. The markets didn't crash, they withered. No one wanted to lend because no one knew what repayment meant anymore. To restore order, emperors tried to fix prices, control wages, and regulate trade. Diocletian's edict on maximum prices in 301 AD was the most ambitious attempt. Thousands of goods and services, each with a legal ceiling. But the market didn't obey imperial decree. Goods vanished, black markets thrived, and inflation accelerated. When faith in the money dies, the law can't resurrect it, and this is the pattern that repeats through time. The problem is never just too little gold or too much paper. It's the moment when the state replaces trust with authority, when it stops asking the market to believe and starts commanding it to comply. Fast forward 17 centuries. The United States, 1971. President Nixon announces that dollars will no longer be convertible to gold. It's called temporary. In truth, it's irreversible. The dollar becomes pure promise, a currency of faith. And for a generation, that faith holds. Productivity, trade, innovation, they grow under its shelter. But debt grows faster. The 2008 crisis was not born on Wall Street. It was born in the Roman Forum, in the same logic. Credit expanded faster than the real economy, and when repayment was demanded, the system froze. Banks stopped lending, confidence evaporated, and government stepped in, again, not to restore balance, but to preserve illusion. Liquidity injections replaced metal reserves. Quantitative easing became the new imperial mint. We tend to think of economic collapse as chaos. In reality, it's precision. It follows a sequence. First, abundance breeds complacency. Then, speculation distorts value. Credit stretches beyond collateral. Panic triggers contraction. Authority imposes control. The cycle completes, only to begin again. The Roman historian Tacitus wrote that the more corrupt the state, the more numerous the laws. He could just as easily have been describing the modern regulatory apparatus. Each new layer of oversight conceals, rather than resolves, the fundamental tension. An economy addicted to expansion cannot survive stillness. By the late Empire, money had ceased to be a medium of exchange. It became a weapon of control. The state collected taxes in kind, grain, oil, livestock, because the coinage was worthless. Citizens fled cities, abandoning trade for subsistence. The empire didn't fall to invaders. It collapsed inward, under the weight of its own contradictions. And here lies the true problem. Not inflation, not debt, but denial. Every civilization insists that this time is different. Rome said it. The British Empire said it. Wall Street says it still. Yet every curve, every policy, every bailout traces the same geometry. When the promise exceeds the possible, collapse becomes the only correction left. So when we look at history, the question isn't how Rome fell, it's how long denial can delay gravity. Collapse is never random. It follows rules as precise as physics. Economies, like ecosystems, depend on balance between credit and collateral, production and consumption, belief and proof. When one side grows too fast, the system compensates until it can't. Then correction becomes collapse. In the Roman world, the mechanism was simple. The empire expanded by conquest, financed by debt. War brought plunder, gold, slaves, land, which repaid that debt and fueled more expansion. It was a perfect feedback loop, until the frontiers froze. When no new territories were made to pillage, the inflow of wealth stopped, but the cost of maintenance didn't. Armies still had to be paid, roads repaired, bread distributed. The budget stayed imperial, the income became provincial. So the emperors turned to the mint. Each coin contained a little less silver, a little more promise. The official face value stayed the same, but the real value fell. The short-term result was liquidity, more coins in circulation. The long-term result was corrosion. People began hoarding old coins and rejecting new ones. Gresham's law, long before Gresham himself. Bad money drives out good. At the same time, taxation rose. Peasants paid more in weaker currency, merchants squeezed prices, soldiers demanded bonuses. The state tried to control it all. Price edicts, wage freezes, compulsory labor. Yet the harder it tried to fix the mechanism, the more it jammed. The real economy, the farmers, artisans, traders, began to withdraw. Production shrank. Money velocity collapsed. The empire had entered a liquidity trap centuries before the term existed. Now compare that with our own machinery. Modern finance runs on the same logic, only digitized. Debt creates growth. Growth justifies more debt. Central banks issue liquidity to sustain expansion, but the underlying productivity, the real goods and services, can't keep pace. So the money supply rises faster than the value it represents. The ratio between symbol and substance widens, quietly, invisibly, until confidence becomes the only collateral left. When the imbalance peaks, interest rates become the lever of control. Raise them and the system tightens. Lower them and it inflates. Yet each adjustment merely shifts pressure from one point to another, from households to corporations, from nations to markets. Nothing disappears, it only migrates. In both Rome and Wall Street, the illusion of stability depended on flow. As long as transactions continued, whether in grain or derivatives, the structure held. But when confidence slowed, liquidity froze, and the circuit broke. In that instant, money ceased to move, and when money doesn't move, time stops. Economies measure not wealth but momentum. Some historians compare the late Roman economy to a body suffering circulatory failure. The blood still pumped, but the arteries were blocked. Today, the same metaphor applies. Quantitative easing is not growth, it's transfusion. It keeps the patient alive while the disease progresses. The mechanism is self-reinforcing. Expansion breeds complexity. Complexity hides fragility. Fragility invites control. Control accelerates collapse. Every empire believes it can outsmart the sequence, until the sequence outsmarts it. This is why history repeats, because the machine isn't evil or random, it's efficient. It maximizes energy until it burns through its fuel, trust. Once that resource is gone, no innovation, no decree, no rescue fund can replace it. You can print currency, but not confidence. And that is the point we're approaching again. A world economy inflated by decades of leverage, governed by algorithms, yet still ruled by the oldest force of all, belief. The mechanism hasn't changed, only the symbols have. When cause and consequence blur, the system begins to eat its own logic. When the mechanism finally breaks, it doesn't make noise. It fades. Trade slows, trust shrinks, and reality quietly corrects the illusion. Every empire faces this moment, when the charts no longer match the streets, when statistics promise growth while people feel contraction. That is the true beginning of decline, when truth becomes an inconvenience. After the Roman currency lost its credibility, entire regions reverted to barter. Cities emptied. Landowners fortified their estates. Soldiers were paid in food, not coin. Taxes collected in wheat were stored in granaries that once held silver. The economy had not collapsed. It had regressed. The complexity that once symbolized strength became unmanageable weight. Governments tried to impose order by decree. They demanded production quotas, froze occupations, punished speculation. But the more they regulated, the smaller the market became. Commerce shifted underground. Corruption became the new liquidity. It was no longer about profit. It was about survival. The empire turned inward, bureaucratic, brittle. The system that had once conquered the world could no longer feed its own capital. Every stage 5 looks the same. The numbers still move, but they no longer mean anything. Inflation masks insolvency. Official optimism replaces analysis. And the price of stability becomes freedom, economic first, then political. Control is always the final currency. The late Roman world offers a blueprint of this transformation. As private enterprise died, the state absorbed everything: production, trade, labor. The economy became militarized. To keep the machine running, new taxes fell on fewer shoulders. The middle class, the true engine of any civilization, disappeared. Wealth concentrated at the top, poverty spread at the base, and the distance between them became unbridgeable. When inequality peaks, trust evaporates completely. Money loses its social meaning. The rich hoard, the poor withdraw, and consumption stops serving purpose. Rome's grand villas stood empty, their marble baths cold, while peasants traded grain for sandals. Luxury without circulation is a monument to exhaustion. The same logic reemerged in every following collapse. In 17th century Spain, silver from the New World flooded Europe, but real production stalled. Prices rose, wages stagnated, and the empire drowned in its own abundance. In 1929, America's prosperity turned to dust in weeks. In 2008, the virtual wealth of mortgage-backed securities evaporated overnight, leaving real debt behind. The mechanism changes names, but not behavior. The cost is always measured in human terms. When systems lose balance, people lose certainty. The Roman farmer who abandoned his land to escape taxes has the same face as the modern worker displaced by inflation and debt. Both are victims of the same equation. When the system protects itself first, it sacrifices the individual. Some historians call this phase the silent fracture. The economy doesn't explode, it quietly divides. Officially, everything continues. Budgets approved, markets open, currencies traded. But underneath, a second economy forms, parallel, local, informal. In Rome, it was barter and local coinage. Today, it's digital payments, crypto, and shadow credit. The structure doesn't end, it mutates. And then comes the reckoning, not moral, but mathematical. The state can print money, but not value. It can legislate labor, but not productivity. It can buy time, but not trust. Each intervention delays collapse, making it deeper when it arrives. Rome's bureaucracy outlived its economy. For 2 centuries, it managed decline with spreadsheets carved in wax. This is the final paradox. The stronger the control, the weaker the organism. Rome did not fall in a single event. It calcified. It became too centralized to adapt, too rigid to renew. That is how systems die, not from shock, but from stillness. We often imagine collapse as apocalypse. In truth, it's administration. Endless decrees, minor crises, quiet resignations. Until one day people stop believing and the system stops pretending. The consequence of every overextended promise is the same. A society that mistakes activity for vitality and policy for purpose. If this helped you see the cost behind the numbers, tell me where you're watching from. Then it was called debasement. Today it's called quantitative easing. The names changed, the logic didn't. When a system can no longer balance its books, it prints belief. And belief, once again, becomes the most valuable and most fragile asset in the world. The modern economy no longer meant silver. It meant promises, digital, abstract, invisible. Each line of code in a bank's balance sheet is a pledge to repay later, using value that doesn't yet exist. That is the true definition of credit, the future, sold in advance. The miracle is not that it works, it's how long it lasts. In 2008, the illusion cracked. For a moment, the machinery stopped. Banks collapsed not because they ran out of money, but because they ran out of confidence. The gears of global finance depend on trust between institutions. One fails, and the others stop moving. Central banks intervened, pumping trillions into the system, promising stability. It worked, just as Tiberius's emergency loans once did, temporarily. The underlying problem remained untouched. Growth built on leverage. Every dollar of new wealth required more debt than the last. Productivity flattened, but financial assets soared. The same imbalance Rome faced. Too much symbol, too little substance, had simply moved from metal to digital. And yet, the illusion returned stronger than ever. Zero interest rates made money infinite, or so it seemed. Debt became cheaper than time. Corporations borrowed not to build, but to buy back their own stock. Governments borrowed to postpone reform. Consumers borrowed to sustain lifestyles once supported by wages. The system expanded, but not forward, only outward, like a bubble inflating around its own emptiness. Then came the next shock, 2020. The world stopped moving and the money printer started again. This time, liquidity didn't just stabilize markets, it entered every pocket, every app, every account. $1 trillion conjured by keystrokes dissolved the old boundary between fiscal and monetary power. For the first time in history, money creation became a public spectacle. Rome's hidden mint was now live-streamed. And as always, the short-term cure became the long-term disease. Inflation returned, first denied, then explained, then renamed. Transitory. But the pattern was permanent. Supply chains broke, energy costs soared, housing detached from income. The modern empire, built not on legions but logistics, began to strain under its own weight. Today's economy floats on a sea of numbers detached from physical reality. The United States owes more than $34 trillion. Global debt exceeds 350% of GDP. The scale is unprecedented, but the principle is ancient. As long as trust holds, paper wealth remains real. Once it breaks, it evaporates faster than any currency ever melted. Some analysts argue this time is different, that digital finance, artificial intelligence, and central bank coordination can prevent collapse. But history's verdict is cruel. Complexity increases fragility. The more advanced the network, the faster contagion spreads. Rome had coins. We have code. Their panic spread through rumor, ours through data. But the human psychology beneath it hasn't evolved at all. The same emotional cycle drives the system. Optimism, leverage, denial, panic, control. Only the instruments have changed. The Roman treasury enforced stability with edicts. The Federal Reserve does it with policy language. Forward guidance is the new imperial decree. And now we're in stage 5, the phase of control. Interest rates are weaponized to discipline inflation. Capital moves under surveillance. Digital currencies are being designed to track every transaction, ensuring stability. It's efficiency, yes, but it's also confinement. The freer the money becomes, the tighter the oversight. Rome issued new coinage to reassert authority. Today we issue new code. Every civilization reaches a moment when the economy stops serving society and society starts serving the economy. We are living through that inversion. Productivity no longer measures prosperity, it measures compliance. People don't work to create value, they work to maintain solvency. The empire doesn't expand outward anymore, it expands inward into screens and systems. And yet, denial persists. Stock markets rise even as real wages stagnate. Governments promise growth even as populations age. Innovation masks decay. The illusion of motion conceals the absence of direction. But under the surface, something shifts. Just as Romans fled the cities for self-sufficient estates, people today withdraw from centralized systems, remote work, decentralized finance, local economies. Not rebellion, but adaptation. The instinct of survival repeating itself. If the 20th century was the age of globalization, the 21st may be the age of fragmentation, networks splintering, currencies competing, power decentralizing. The empire dissolves not in collapse, but in multiplication, and perhaps that's how modern decline will look, not the fall of a tower, but the quiet fading of unity. We are told that technology will save us, that innovation can outpace the curve of debt, that AI can optimize the inefficiencies of human greed. Maybe. But history whispers otherwise. No system has ever coded its way out of entropy. The data may be digital, but the cycle is organic. Then it was Rome, now it's us. Different tools, same pattern. The 7th phase, the reset, hasn't arrived yet, but the indicators are already visible. Exhausted growth, strained confidence, rising control. The formula is complete. The reaction has begun. And now imagine, if the system is still repeating, maybe history isn't behind us. Maybe we are the next chapter, written in numbers, not marble. Every empire believes it will be the last. Rome believed it, London believed it, Washington still does. The illusion of permanence is humanity's most consistent investment, and its most expensive. The pattern never ends with destruction. It ends with transformation. When a system exhausts its trust, it doesn't vanish. It mutates. Gold turns to paper. paper to data, data to control. Each step seems like progress, but the direction is always inward, toward concentration, efficiency, and fragility. Stage 7, the reset, is not a single moment. It's a recognition, the collapse of one logic and the birth of another. In Rome, it was the shift from empire to feudalism. In the modern world, it may be the shift from globalization to digital sovereignty. The economy won't disappear, it'll simply relocate from institutions to individuals, from centralized power to distributed code. Some will see it as decline, others as liberation. Both will be right. Because every reset is both an ending and a beginning, the breaking of one illusion to make space for the next. And perhaps that's the lesson buried in 2,000 years of repetition. History doesn't punish arrogance, it recycles it. Each generation inherits not the wisdom of the last, but its unfinished consequences. We are not living after Rome. We are Rome in a new form. The cycle will turn again. The question is not if we can stop it, but what we choose to build when it restarts.